For years, the UAE stayed out of conflicts and positioned itself as a neutral country, though being surrounded by the hotspots on the map. That's what made Dubai a safe haven for international capital. Now this assumption is being questioned. Dubai historically benefits from the regional instability, but it works only while the city remains outside of the conflict zone. Iranian strikes across the region affected Gulf infrastructure and airspace, but more importantly, they affected the perception. The reputation of the region as an untouchable safe zone has been challenged. The UAE is not only geographically inside the system, is no longer fully insulated from it. Already lots of haters started talking about the collapse of real estate market in Dubai. To be fair, there are actually two types of narratives. From one side, the salespeople keep saying how safe Dubai is and that the market will remain strong no matter what, so keep calm and keep buying.
Our opinion is that all of them might really happen only if the conflict continues for a significant period of time. If it remains short-term, that nothing will really change, and the market traction will remain the same.
From the other side, aggressive global investors that immediately start hunting minus 50% deals, just look at these requests.
We're getting many messages from clients asking if we can finally start getting bigger discounts from developers, or they're wondering if people are finally panic selling good properties.
In this video, I will cover my thoughts about how the situation will affect the region economy and, of course, the real estate market that is at the end of the chain. We will look at areas perception shift, rental market, insurance, construction costs, sales prices, demand flow, and the most important, will separate marketing narratives from the reality. To start with, I want to show you this video because it demonstrates a very common narrative of the salespeople.
UAE proved to be one of the, if not the safest place globally. The UAE's safety was tested, and the country passed this test at a level that got nothing but the highest respect for the local government. Now let me share some numbers for New York. According to the police department of New York City, in 2025, there were registered 29,838 felony assaults. You have a much higher probability of getting stabbed during a normal day in London than getting hurt during a bad day in Dubai. So it's really important that now we have real proof that the city remains super safe even during events like that.
Comparing missile attacks to crime stats in London is mixing apples and oranges. UAE proved to be one of the safest places globally. This is a conceptual substitution. Air defense interceptions doesn't equal the safest place in the world. These are two completely different things. Safety from crime and safety from geopolitical war infrastructure risks. These two categories are mixed up intentionally to produce a convenient conclusion to justify the thesis. Keep buying, nothing changed. A comparison with New York or London stabbing or felony statistics is a cheap trick. This is not evidence, this is an emotional framing shift. You're comparing everyday crime stats with a military incident and then concluding, see, it's still safer. For an investor, this is irrelevant. Real estate market reprice geopolitical risk, not just crime rates.
Everyone here is really impressed by the level of the security created by the UAE government. Life continued as usual. Malls are open, food delivery apps are working, restaurants and cafes are open, many people are hanging out outside and living their normal lives. And this brings us to how all these events affect the real estate market.
Life continued as usual. It's a very short horizon. The fact that cafes are open doesn't mean the capital won't reprice the risk. Capital doesn't react only to daily life. It reacts to insurance premiums, logistic costs, aviation and hub risks, the reputation of a safe haven, internal rules from the developers, property managers, insurers, and lenders.
But off-plan is easy to regulate. If demand drops, developers simply don't launch new projects. This will not lead to a price drop, because developers fully control the off-plan pricing. They will just keep the prices at least at the same level, and they will reduce the number of new projects.
The thesis that developers fully control off-plan pricing, so no prices drop, in my opinion, is overly confident. Yes, large developers often try to maintain headline prices and regulate the launch of new phases. However, discounts rarely appear as direct price reductions. They usually come through development department fee waivers, commission rise, post-handover payment plans, service fees incentives. Off-plan resales and the secondary market move independently. If credit conditions or demand weaken, developer control is not magic.
The same thing happened before, for example during 2020, even when the demand significantly decreased, big developers maintained their prices.
So these statements sound more like developer marketing than real analysis. And we saw it not only in 2020, by the way, but also earlier because the market correction phase continued for 6 years from 2014 till 2020. So pandemic actually boosted the demand. Now let's leave the marketing bullshit behind and look at the reality. The main outcomes of the situation. First of all, reputation. Dubai and Abu Dhabi took a reputational hit because of their ties and operation with Israel and the US, which in the context of escalation turns into a risk label. Their status as a safe financial haven is questionable, and capital starts looking for alternatives, other jurisdictions and markets. Yes, air defense worked, but the bigger issue is perception and repricing of risk. Second, logistics. For a logistics-driven economy like Dubai, disruption in shipping, airspace, and insurance costs eventually flow through entire economic chain, and the real estate is at the end of that chain. Gulf monarchies depend on maritime supply chains. A significant share of critical imports come by the sea. Disruption to shipping routes means shock to prices and cost structures. And not even the actual closure of Strait of Hormuz, but the mere fact that it can be shut down at any moment is enough to trigger the risk. This automatically raises insurance premiums for vessels and cargo. And that means increasing of shipping costs and alterations to the economics of trade in the region. Third factor is airspace. The airspace for Dubai is extremely sensitive because the entire model is built around being a hub. Passengers, tourism, transit, business, logistics. Even a short-term disruption is a significant hit to perception. Now, how all of this will affect the real estate? The main outcome is that a major war in the Middle East is a trigger for regional repricing by the investors. The logic is if the region becomes higher risk, investors factor it into the decisions. This is not panic, this is pricing logic. Higher risk, higher required returns, lower willingness to pay a safety premium. Then oil, logistics, insurance, cost inflation and pressure. The idea is that raising logistic costs plus insurance plus unstable routes means more expensive imports, goods, construction chains, and operational costs. For real estate, that may translate into pressure on operational expenses, maintenance, service, utilities, also pressure on construction timelines and costs if supply chains and prices rise, and changes in tenant and tourism behavior. Real estate is about trust, not the headlines. So let's summarize. New risk conditions will create a new normal. Trust in a safe haven recovers slowly. Once the market feels vulnerability, the safety premium is reduced for a long time. So let's break it down how the situation will affect real estate. First of all, local repricing of certain areas is possible. Again, it's not a Dubai collapse, it's a distribution of risk premium within the city. Example. Previous narrative was that proximity to airports and ports mean liquidity, demand, and future growth. Now an additional factor enters the equation, perceived risk. This starts competing with the convenience. Which areas will be the most exposed? Dubai South and logistic zones. These areas were previously sold as future hub. Now part of the market asks, how exposed is this location? Second is of course port areas, Jebel Ali and surrounding zones, for example. And third, prime tourist districts like Palm Jumeirah, downtown, Dubai Marina. Those are full of symbolic assets, have high density and global visibility. We already saw that iconic touristic locations and landmark buildings were targeted. This doesn't mean that these areas will collapse or demand will disappear. It means that demand structure will change, which means that safety premium emerges, buyers start thinking, I'm willing to pay more for perceived safety. Second, risk discount appears. In areas near ports and airports, you may see mild discounts or slower price growth. And sales narratives might eventually change. Before, close to airport equals convenience, now it's not longer a pure advantage. It becomes neutral or even debatable. But, important to add, Dubai is a special case. It depends on being a global hub, logistics and tourism. Therefore, these areas cannot drop out of demand entirely. So this might not mean a decline, but it's a recalibration of perception. So the formula before was location means advantage, now location, advantage plus risk. So overall, in sales, we can see less premium, longer and more aggressive negotiation, more selectiveness, However, luxury market will stay resistant, but mid-segment will be the most affected. Now let's talk about insurance and rental market. What might actually change? Will everyone rush to insure property? Short answer is yes, but most probably temporarily. What typically happens? As a human psychology, after incident, surge in interest in insurance, brokers actively push policies, banks remind clients about risks. For 2 to 6 months, it feels like everyone needs insurance now. Then reality comes back in. Insurance is not mandatory unless the property is mortgaged. Many people don't understand coverage, assuming it won't happen to me, and try to save money. As a result, no large-scale long-term behavioral shift. So what actually might change in the insurance policies is premium increase, more exclusions, war and terrorism clauses. Full coverage becomes harder to obtain. And the most important, most insurance policies do not cover war-related risks, meaning that you will pay, but in the worst-case scenario, you are not covered. Now question, will rental prices drop? Short answer, not necessarily, and this is where the paradox is. I would speak about two scenarios. Scenario 1, short-term reaction. People leave, tourism declines, so short-term rentals may drop. Second scenario, immediate aftermath. When uncertainty rises, people hesitate to buy, but they will still need a place to live. So demand often shifts from buying to renting. So the paradox is that rents can increase even when the sentiment worsens. Simply because buying means commitment and higher risk, while renting means flexibility. So people think, I'd rather rent and keep the option to live. But what about short-term rent, holiday homes? This segment is more exposed. It is highly sensitive to tourism, price dumping already happening, operating costs are rising, there are more and more institutional restrictions. As a result, lower profitability. So while short-term rent might be highly affected, long-term rental may become stronger. So to summarize, Dubai is not becoming unsafe, it's becoming correctly priced. What I'd recommend investors to focus on within the next few years. One of the most interesting segments is resale units that are close to handover. Why? Because construction risk is mostly gone, pricing is often more realistic than early off-plan launches, you can immediately evaluate the real product, location and demand. In uncertain conditions, many investors prefer tangible assets over promises. Second category is distress opportunities. Periods of uncertainty often create distressed sellers, but real distress is not original price or original price plus DLD. It has to be -10 to -20 below the current market value of the ready properties of similar caliber nearby. And the third category is off-plan priced close to ready properties. Some off-plan can still make sense, but only if the pricing is close to comparable ready units. If the discount between off-plan and ready properties is too small, the risk-reward balance simply doesn't work. What to be careful with? The riskiest segment right now may be early stage off-plan launches. In many cases, these projects are aggressively priced, dependent on optimistic future assumptions, and exposed to market sentiment shifts. And if you're holding or planning to buy property in Dubai, this is exactly the moment where strategy matters more than ever. Book a call with me, linked under this video, subscribe for more insights about Dubai real estate, and see you soon on the channel.